Hello, FX Limit community. Today, we're diving deep into the fascinating world of Forex trading. Specifically, we'll unravel the concept of Purchasing Power Parity, or PPP, and its crucial role in fundamental analysis for Forex trading. Let's kick things off by understanding what PPP actually means. In simple terms, Purchasing Power Parity is an economic theory that compares different countries' currencies through a basket of goods approach. Imagine you can buy a basket of goods in the United States for $100. According to PPP, in an ideal world with perfect market conditions, you should be able to buy the same basket of goods for an equivalent amount in another country's currency. This concept helps us understand how far a currency can stretch in its domestic market versus abroad. Now, how does PPP fit into the world of Forex trading? When traders engage in Forex, they're essentially betting on the future strength or weakness of a currency against another. PPP provides a fundamental analysis tool, giving traders insights into a currency's fair value. It's like having a compass in the vast sea of currency fluctuations, guiding traders towards more informed decisions. Here's where it gets even more interesting. PPP is not just about the current prices. It also considers inflation rates. Let's say country A has a higher inflation rate than country B. Over time, country A's currency should depreciate against country B's currency. This is because the purchasing power of country A's currency is eroding faster due to inflation. Traders often use this aspect of PPP to predict long-term movements in exchange rates. But let's not forget, the Forex market is influenced by a myriad of factors. While PPP provides a foundational understanding of currency values, it's not the be-all and end-all. Market sentiments, political stability, interest rates, and economic growth also play significant roles in currency valuation. Therefore, successful traders often combine PPP with other fundamental and technical analysis tools to get a holistic view of the market. Now, applying PPP in real-world trading can be quite challenging. The theory assumes that goods are identical in both countries, which is rarely the case. There are also transport costs, tariffs, and differences in product quality to consider. These factors can lead to deviations from what PPP would predict. However, even with these limitations, PPP remains a valuable tool for understanding long-term trends in exchange rates. To wrap things up, remember that Forex trading is not just about following a single indicator or theory. It's about analyzing a range of factors, understanding market dynamics, and making well-informed decisions. PPP is a powerful tool in this arsenal, helping traders gauge the intrinsic value of currencies in a global context. That's all for today's episode on FX Limit. We hope you now have a better understanding of purchasing power parity and its role in Forex trading. Stay tuned for more insights and strategies to help you navigate the Forex market like a pro. Don't forget to like, share, and subscribe for more content like this. Happy trading, and see you in the next video.